Hi guys, my name is Ivio Makoma and I'll be teaching you everything you need to know about Forex trading. This is like the easiest way to understand Forex. So let's get right to it. The first question that most people ask themselves when they get into Forex is this: what is Forex? So let's answer this question for you guys. Forex simply means foreign exchange, guys. As you can see here, they've taken the first three letters of the word foreign, then they've taken the first two letters of the word exchange and combined them and came up with one word, which means Forex. Forex is sometimes abbreviated as FX. So what does this mean actually? What does foreign exchange mean? Foreign exchange is basically the exchange of one currency for another, or the conversion of one currency into another currency. So let me make a simple example about this. Let's say you live in South Africa, and you want to buy something or you want to pay someone in the US. So what you have to do in that instance is conduct something called a currency change. So yeah, when you're changing rands into US dollars, you are actually participating in the forex market. So you are conducting a foreign exchange. Yeah. Foreign exchange also refers to the global market where currencies are traded virtually around the clock. So think of it as a place where you can go and buy or sell currencies or invest in currencies. Let's say you want to invest in the I don't know, you want to invest in the US dollar maybe. You think the economy is growing stronger and you think the value is going to go up, so you go to a broker and you buy the currency, the US dollar currency. Then you'll obviously make a profit if your predictions were right. So yeah. Now let's talk about the participants in this forex market. Like who are who are the people who are able to participate in this forex market? First on the list are governments. So with governments, they actually participate in the market just to meet their financial demands. Things like maybe reaching a low or high interest rates and stuff like that. Then you have the central bank or the reserve bank. Basically, the central bank is a financial arm of the government. Yeah, but in most cases, you'll find that these banks are independent, so they use the forex market to move around their reserve of finances or their reserve of funds and monitor the situation. They monitor things like interest rates, like is everything being done fairly on the market. Yeah, that's basically it. Then you have the banks. Now the banks, they use the forex market to conduct the financial transactions. So what a bank does, a bank takes money from the general public. Let's say you put your money in your account. They take that money. Because that money is insured, they trade that money and they make profits out of that money. Then they pay you. Let's say you have a 4% investment per year, depending on the contract of that bank. Then you'll maybe get a 4% of that investment. So that's basically how they trade. That's basically how they can actually afford to trade in large amounts of money, because they're using the general public's money to trade. Yeah. Then you have the financial institutions, things like the pension funds, all these big financial companies like insurance companies. They also participate in the forex market because they have such huge reserves of money that they feel the need maybe to participate in the market and possibly come up with profits. Then we have big international companies. Now, these big international companies, in most cases, they have to pay staff. Let's say they pay someone in Germany. Let's say Coca-Cola is someone working in Germany. So they have to pay the staff in Germany. So they have to change their currency, the US dollars into pounds. Yeah, then we also have hedge funds. Hedge funds. What are hedge funds? Hedge funds are these big companies that they take. Okay, let's put it this way. Let's say you want to make an investment in the forex market and you have huge sums of money. So what you would do, you would approach a hedge fund. So what the hedge fund would do, they would take that money and they will pay. They would place a trade on your behalf, and then if you make any profits, they will charge you a percentage of those profits. So that's basically what a hedge fund is. Um, then we have retail traders. Retail traders are normal people like you and me. Normal people like you and me don't basically have a place in the forex market, but we have been awarded the privilege by the introduction of brokers into the forex market. So we'll talk about brokers later, but thanks to these guys, we're able now to participate in the forex market. So we are called the retail traders. We're basically the small fish in the sea. We traded small amounts of money, and the profits we make are not even a fraction compared to what these other institutions are making. So yeah, these are basically the participants in the forex market. Um, Maybe you're wondering how much does forex generate? So here's your answer straight in your screen. It generates $5 trillion per day. So there's a lot of opportunities available for everyone here. So 5 trillion is not a small amount of money, because forex trading is basically the most liquid market or the most lucrative market in the world. So you can basically get rich off of trading forex, but you can also get broke off of trading forex. It just depends on the type of information you have. So if you have the right information, you will actually move in the right direction. So yeah, let's move along. Now let's talk about forex brokers. Now, how are these forex brokers helping us gain access into the forex market? Okay, let's look at this chart. Let's say this is forex, and these are all the companies that are participating in the market. Now these companies are actually trading among themselves with huge amounts of money, types of monies that we could never afford as individuals. So what happens is, you as a retail trader, you want to tap into these markets, but you let's say you need representation. So what brokers do, they provide that representation for us. So what they do is um, they collect money um, from let's say we all using one broker. So all of us are going to pay our money into this broker, and what this broker will do is take that money and send it to the bank. You understand? Then the bank will conduct that forex transaction on behalf of the broker. So a broker needs a connection with the bank. You understand? So that they can perform transactions for them. So now a broker is there to facilitate everything for us. So they take all of that money, and it makes huge amounts, and they just conduct our foreign transactions. So yeah, this is everything you need to know um, about forex and brokers. I hope this lesson was informative or easy enough for you to understand. Welcome to your second tutorial of forex trading. Today we're going to be talking about forex charts, how to read a forex chart, how to understand price action. Yeah, so basically, in order to be able to read a chart successfully, you need to understand price action. So price action is actually the movement of the price. So you need to understand when the price opens, when the price closes. You need to understand how to identify the highest point at which the price has reached on a specific day, and you also need to understand the lowest point at which the price reaches on a specific chart. So let's look at that in a simple graphical sketch. Let's say this is a daily chart. As you see here on the bottom, this is your time frame, and on your left is your price. You understand? Okay, let's take let's take day two for an example. Day two for an example. Let's say on day two the price opened at its lowest and went on to close at its highest. Now, after it had opened, it moved to its lowest. This is the lowest block point at which the price moved on that day, and this is the highest point at which the price moved at the day. So as you can see, the price movement of this chart was from here. It opened here, went down to this point represented by the X, then went up again to its highest point here, to this section here represented by the X, then it went down again to close here. Now if you join these two X's together, we form a bar chart. So this is how a bar chart would look. Oh, I forgot to tell you that in Forex we actually have three types of charts: a bar chart, a candlestick chart, and a line chart. So yeah, so this is how a bar chart would look. As I've explained to you, now you saw the whole thing, the whole story of this price action. So now you're able to understand how this price moved. So yeah, this is how a bar chart would be represented. Here, this would be your open, your low, your high, and your close. And on your average Forex chart, this is how this would be plotted. I mean, it would look. As you can see here at this point, price opened. Price always opens on the left. Then it went up to its highest point. Then it moved down to its lowest point. Then went up again and closed at this area. Then the next bar opened. You understand? Same story as the first one. So this is how this is the proof. This is a movement of the entire price action on that specific day or that specific time frame. This is how price action would have moved. Now you would find this chart as a simple black like this on the graph, or you would decide to change maybe to a red and a green, which is what I like, because the red represents bearish and the green represents bullish. I will get to that later. I'll tell you more about the bulls and the bear later down the line. We move on to our candlestick. Now the candlestick is, I'd say it's the same thing as a bar chart, but it has more information because price action moves with the time. If you see the square here, the square area here, it will move as the price move at a specific time frame. You understand? So this is your body. We actually call this a body. We don't call it a square. This is a body of a candlestick. We call this a candlestick because it looks like a candlestick or a candle. This is your body. This is where price action will be represented, because this action will be moving all the time, constantly moving on your chart as price is moving. And your highest point is not called the highest point at this on this candle chart. Rather, we call it a shadow or wick rejection or wick. You understand? Yeah, this is basically a basic illustration of a candlestick. Now a bearish candlestick, in most cases you'll find that this is how an M4 or a MetaTrader 4 would appear after you've downloaded it. So you need to know that these black boxes here, these filled boxes are actually bearish boxes. These empty ones are bullish. Yeah, but you don't have to worry. You'll understand everything as we move along, and you'll be able to set your chart accordingly. These are just preferences. My preferences are red and green because they are just simpler to understand and just to read. You don't have to look hard on a chart when you're reading this. So yeah, then we have a line chart. Now a line chart is a simple line chart. it only represents the closing areas of price action. As you can see here, the price is moving and it closes here. It shows that it closes and it moves to another direction. It closes and it moves in another direction. It closes, then it moves, and so on. Like it's we mainly use line charts when we want to identify certain areas on the chart. Let's say you want to find your supply and demand, stuff like that. You want to identify a specific area of price action. Yeah, those are the things that we basically use it for on Forex. Yeah, it's also a useful thing though. Yeah. This is how it would look graphically when it's represented on the chart, on an actual Forex chart. This is how a line chart would look. As you can see here on these points, it represents price at a certain area. You understand? So let's say if you wanted your support and resistance, you're looking for support and resistance, you'd know that these are the 2 points you need to join, because it's a bit clearer than the other charts. Yeah, this is how your candlestick chart would look on a graph. As I've said, these boxes here, they would be moving constantly on a graph, representing the price movement at a given time. Yeah. Good day, guys, and welcome to another course on Forex trading. My name is Iviwe. Today we're going to be talking about reading currency pairs. So today you're going to learn how to identify or how to decipher currency pairs. Let's move along. In front of us here we have the daily chart of the Euro USD. Now, if you're looking at the right hand side of the chart, you'll see the price of the Euro USD, and if you're looking at the top left corner, you'll see the quoted currency. Now, the quoted currency consists of two currencies that are combined. That's why it's called a quoted currency pair, because it has two currencies that work hand in hand. So we have the base currency and we have quoted currency. The base currency, basically, if you're talking about the base currency, you know that every information that will be reflected from the chart will influence the base currency. So if in this case we have the euro as our base currency, so every information that is reflected on this chart here, like our candlestick patterns, like the movement of the price. Now let's say in this case the price is moving down, we know that it's affecting the price of the euro. So now we know that the euro is moving down in this case, so the euro is dropping. Then we have the quoted currency. Now the base currency is priced at the quoted currency. So in other words, 1 euro will be priced at the value of the US dollar in this case. So it's going to be 1 euro is equal to 1 USD. Let's look at it. Let's make a simple example of this. Now, in this case, we have the euro USD is equal to the price, right? Now let's split this two so that you can be able to identify this or understand this much easier. Now let's change these euros into apples. Now our base currency has changed into apples. Our quoted currency has stayed. What this means is that the value of one apple is equal to the price of the USD at the time. You understand? So one apple is equal to 1.2524 USD. You understand? So this is basically what this is the concept of this whole thing. So if we change back now and remove the apples, we know that 1 euro is equal to 1.254 USD. This is basically how we read the currency pairs. So you know that the euro is always equal to the USD. You understand? Always equal to the price of the USD. I hope that made sense. If it didn't make sense, just make sure you comment with your question below. Basically, we have over 180 currency pairs around the world. You can just pair them up whichever way you prefer, and you'll come up with if you pair if you pair any of these two together, you'll come you'll come up with a currency pair. I'm really sorry about that. Yeah, and we have the majors and we have the crosses. Now the majors are currency pairs that consist of the US dollars. So the US dollar is always involved in this with the majors. The crosses are the currency pairs that do not involve the US dollar in them. We also have exotics. Now exotics, traders don't normally trade these, but we do trade them. But these are the most traded ones. So yeah, that's it for today's lesson. Hello guys, welcome to another course of Forex trading. My name is Iviwe and today we will be talking about the bulls and the bear and basically discussing the terminologies that lie behind buying and selling. Yeah, let's see. In Forex, we have two types of investors. We have the bulls, or the bullish investors, as some might call them, and we have the bears, or bearish investors, as some might call them. Bullish investors are the type of people that look to invest in the growth of a currency. So they are looking for buying positions or going long, as we might say as Forex traders. They're always looking for opportunities to buy and hoping that the trend will move in their direction or in the upwards direction. Um, Bearish traders, on the other hand, are always looking for shorting opportunities, or in other words, selling opportunities. So they're always looking to short or to sell um, um, currency pairs. So they're investing on the decline of a currency. Yeah, so let's look and see how a bullish trader would trade or and discuss the terminologies or the mechanics that lie beyond this trade. If you're looking at this chart here, you are seeing an upward trend on the GBP USD chart. Now, a bullish trader would want to buy this trend, but they would want to get in on the lowest point of this trend and then exit at the highest point where they would have made enough profits. You understand? So in this case, this bullish trader would buy when the price is at 1.440, then exit when the price is at 1.5950. So this is when the value would have gone up and the profits would have been made. This is when this investor would close the trade. Let's look at the details and the dynamics and try to break this down. What actually happened during this trade? Let's say this trader had 1,000 rands, right? And this trader was looking to invest in the GBP USD, which was priced at 1.440 at the time. So this would mean that this trader can afford to buy a certain number of units of this quoted currency. Let me make a simple example of apples, for instance. Let's say one apple cost 1.440 at the time, and this trader had 1,000 rand. So with 1,000 rand, this trader could buy 694 apples. You understand? So when he actually bought into these apples, he is now waiting for the value of these apples to increase so that he can make a return on his investment by the growth of the value in those apples. So what happens is that the value of the apples really does increase and reaches a different value, which here is 1.595 So the value is now higher than it was before, meaning that the investor actually made a profit. They still have the apples or the initial the initial investment they made before, and now they have an additional profit. This is where they actually closed the trade. So in other words, they now have $1.107. You understand? So it's the initial investment plus the closing profit. You understand? Yeah, now we change this whole thing and put it back to the quoted currencies so that you can see everything. They bought at the lowest and they sold at the highest. In fact, they closed at the highest at the profits. So basically, this is the basic terminology or the basic concept of how a trade is conducted, or how a trade actually accumulates its profits. I hope this section was actually clear for you. Now we're going to talk about selling or short selling in the forex market. Basically, selling or shorting in the market, and the term selling is the most common term used by traders today, by forex traders. Short sellers are actually popular with the stocks, but now we're talking about the markets. Now let's look at the bears or bearish investment. The bearish investors will always look for a downtrend. Like in this case, you can see the downtrend that the currency is actually falling, the Euro USD. Now, in this scenario, a bearish trader will go in for a sell. You understand? So they're looking for the value of the price to actually go down. What happens here is they will go in at the highest and exit at the lowest. So they'll wait for the value of the apples or the value of the currency to actually go down and reach a price that's below the initial price, so that they can come up with a profit. In this case, you can see that this trader will close their trade at 1.2480. Yeah, that's basically it for today. One more thing, apples were just an example that we're using for this scenario, and you should understand that currency pairs or quoted currency pairs are not apples. In this market, you cannot come in and expect to buy markets. And I mean apples. You do not buy apples here. We buy currency pairs. Yeah, that's it for today.